Welcome back to a brand new video. I hope everyone had a fantastic Thanksgiving. I know I did, but since the holiday's over, it is back to the grind. And in today's video, we're going to be talking about liquidity grabs. So I know my bootcamp series, I have a video about liquidity in general, but I want to dive much deeper and explain the use of this smart money concept and why it's so valuable. So let's go ahead and jump straight to it. So a liquidity grab, often known as a liquidity hunt or stop run, is a strategic move in day trading where large market participants, often referred as smart money, such as institutional day traders, unintentionally move the price of any asset to trigger stop loss orders or take advantage of any resting liquidity at certain price levels. In the markets, this can result in sharp, sudden price movements that can catch smaller traders off guard. So if we come to the chart, let's just go on, we're on gold right now. Let's come to the side. So here in the chart on gold, let's just come to the side and talk about this concept. So in the markets, we know there are three type of primary conditions. There is a uptrend market, there is a downtrend market, and then we have a ranging market, right? So with an uptrend market, let's go ahead and make this a little bigger. How does one identify an uptrend trend? You need to be able to identify some structure. So with an uptrend, we know that we have to be able to find some higher highs and higher lows. This low being much higher than this one, which makes that a higher low, and this high being much higher than this one, making this a higher high. So at every point of structure, liquidity is being created. Why? Because we are not the only ones in the markets that are trading. And because we are in an uptrend market, it's one of the most basic retail concepts. People are buying and selling at these pivotal points. So at this high, people are selling. At this low, people are buying. At this high, people are selling. And at this low, people are buying. Now, what this is actually doing is creating some sort of value, aka liquidity, for when the market decides to finally reverse and start pushing down. And that momentum in which price starts to become bearish is motivated towards areas that have not been taken out yet. So notice how these areas between our entry and stop loss have not been tapped because price pushes up down here as well. So this whole area is holding some sort of value, aka liquidity. So when we have a reversal in the market, or when price usually forms a gap, well, that gap usually forms because the market is correcting itself. It's just taking out those orders before it starts to push up in another range. So eventually, when we get this downtrend, let's say the market touches a all-time high, and then in the downtrend, same thing. You can't identify a downtrend market unless you have structure. So areas of lower lows and lower highs, this high being much lower than this one, and this low being much lower. This low being much lower than this one. So same thing with a downtrend market. People are hopping in for sells at this high and they're hopping in for buys at this low. But back to this concept of liquidity, once price starts pushing down, it's actually taking out these orders to correct itself. And eventually, what does price do? Finally comes back down to that all-time support before it starts pushing back up. And you'll see this all the time. So let's talk about it. Let's just try to find an area where price replicates this concept. So right here, boom. So if we take this piece of price action, let's get the replay button and come to around this area. Notice how the market is trailing up. We clearly see that price is bullish. Now, if I was trading this market, in this example, I would try to find where price had a consecutive push. So on the 15-minute scaling out, we can see that there are consecutive candles back to back at around this area. So just before we get that push, let me scale back in, and I'm going to draw out a zone, making this our 5-minute demand, where price is eventually going to pull back to. Now, although we have a nice zone of demand, we have to keep in mind that we are not the only ones in this market. A lot of people around the world are placing buy limits at this zone. So if we think about a limit order or a buy limit, a lot of people are placing orders right here. They're placing orders right here. There are several pending orders either hovering above or below this zone. And what does that do? It creates a lot of liquidity, value that is yet to be taken out from the other side. So if we continue, let's just see what price does. It starts to pull back, taps that zone. Now notice we get a touch right here. What does this do? Create more liquidity, because although the market does correct itself, what this is simply doing is allowing buyers to have more opportunity. So because we have this nice zone, finally touches that LPI, we have more people hopping in right here. And what is this doing? Creating more liquidity below this zone. So eventually, boom, right here, beautiful. We get this nice liquidity grab where you'll see this wick take out these orders before it initially pushes back up to correct itself. This is a really good example. And I like this one specifically because you'll see this all the time where price will just wick taking out these orders before pushing back up to its designated range. So the main takeaway from this example is when you have a anticipated zone of entry where you know a lot of people are hopping in the market, maybe off of a simple retail concept, maybe off of support and resistance, maybe off of fair value gaps, keep in mind that you are not the only person hopping in. So because there are so many people, it's generating a lot of liquidity. So one question you might be asking yourself is, when do we know that price might actually take out orders before pushing back up? Because if we were in this trade, which was profitable, if we were in this live market, how do we know that it's going to react the way that we want it to rather than wicking us out or grabbing orders before pushing up? Well, the simple answer is you don't want to place a trade in an area where price already performed. For example, we have concepts of double tops and double bottoms. There's a reason why we don't have concepts that say like triple tops or triple bottoms, because the more times price touches a given area or zone, this is why we have ranges, such as this. Eventually, we're going to have a breakout because all of these touches are simply generating areas of liquidity. And you guys will see me use this all the time as I trade live when I split price in the ranges, because I'm trying to identify where price eventually, takes out liquidity. Let's pull this over here. Where price eventually pushes up and takes out liquidity and has a nice break and retest into another range. And then I have like my numbers where I separate these ranges so that you can clearly see what price is doing and why price is doing what it's doing. Let's look at one more example. Let's go to S&P 500. So in S&P 500, let's just use what we have right here. Let's box in price and push price back to around this area. Oops. Okay, here we go. So here on S&P 500, what do we see? Well, since I'm on the 30-minute time frame, let's just scale down on the 50-minute and try to find where price had a most recent push. We have these nice bullish consecutive candles, and then most people will draw out a zone of demand right here, calling this our 15-minute demand zone. And what I want you to notice is that price does fluctuate and taps that HPI, which most would call a fair value gap. So like if you wanted to, you could place a zone right here, which is fine. We'll do it in this example because it is pretty accurate, where price does make a rejection before pushing back up. So because we have this piece of data, most buyers, to be specific, are hopping in right here. So there are thousands of traders hopping in at this pivotal point right here at this zone, at this 15-minute fair value gap. And what is this doing? Creating liquidity. So there's a lot of liquidity floating below this zone. So what's going to happen? Well, eventually these buyers are going to be stomped out of the market. So what are we going to do? We're going to wait for price to come back down. And instead of entering on impulse at this zone, we're going to wait for price to actually take out these orders so that we have zero drawdown. So let's go ahead and continue. Price does its thing, form a nice gap. And remember, a lot of people are still hopping in the market. So people are hopping in right here because we're in an uptrend market. So there's structure where people are hopping in at these points or these lows to have a nice continuation. So there is more liquidity being generated, but we're going to focus on this pool of liquidity floating below this zone. So as we continue, price then starts to reverse, break structure, takes out buyers right here, right? You could say this was a liquidity grab as well. Push it down, and then boom, price finally makes its way back to the zone, and let's just observe what happens. We have a huge candlestick, then it turns into a strong wick, and then what do you know? Price pushes back up. Now that I think about it, this actually isn't a fair value gap. This is more considered demand like I had before. A fair value gap doesn't go in between the first and third candle. So notice how this wick is overlapping this one. So I do apologize for that. Sorry for the confusion. But anyways, notice how price taps our demand zone, but has a wick and then pushes back up. Now this wick, just like the first example, is simply taking out previous buyers before pushing back up. Why? Because there is a lot of value. And just so you guys can see this more clearly, let me just delete the zone. And hopefully this is better. We have this nice zone. Price comes back down, has a strong wick. So we would wait and then enter in the trade on the open of that candle so that we don't risk any type of liquidity grabs. And this is what I use every single day in the market, where we wait to see if price is going to have an impulsive move to take out liquidity before initially pushing back up in its given direction. So yeah, that's all I have for this video. Hopefully this was helpful. Again, if you guys want more help on this, if you want another video on this concept, let me know down below. I try to make my videos not too long, but if I need to make a longer video with another part with more examples, just let me know and I'll be more than glad to do so. Quick announcement, my Discord has been active for about 2 weeks now, and so far so good. We are 100%. And the main thing that I give in my community is education. You know, I send out trade ideas, and then I have my daily recaps, weekly webinars, and then we have one-on-one mentorship in case you guys need access to me. So if you notice, my Discord community is really cheap right now, and I think I'm going to keep it this way up until 2025, just because I know it's the holidays and I know a lot of people are trying to save their money. I really want to try to make it accessible so that you guys have a chance to get in before the price moves up. So if you guys want to check it out, you can get that 7-day free trial, test the waters, see if it's something for you. If not, you can always leave before that trial ends. But yeah, that's about it. Hope you guys enjoyed this video. I'll catch you guys in the next one. Always remember, we are in for the long game, not the short game. Till next time, stay easy, stay breezy. I'm out. Peace.